Welcome to The Explainer. Today we are digging into a really strange situation happening in the silver market. You see, the price of the metal itself is absolutely soaring to historic highs, but the companies that actually pull it out of the ground, well, they're being left in the dust. So let's dig in. Okay, so here's the central mystery we're unpacking. Silver has been on an absolute tear. I mean, it's been one of the best performing assets out there. But the mining stocks, the very companies that should be cashing in on this boom, they're lagging way behind. So what on earth is going on here? And just to set the scene, let's put a number on it. We're looking at a world, January 2026, where silver is holding firm at prices we just haven't seen in decades. Now, in theory, this should be a silver age for the companies that produce it, right? And yet, this quote from our source material just nails the situation. The miners are being suppressed. It's like someone is trying to hold a beach ball underwater. You know it wants to pop up, but something is forcefully holding it down. It's a tension that just doesn't make financial sense. So let's look at the hard data, because this isn't just a hunch or a feeling that investors have. This is a real historic anomaly that you can see clear as day in the numbers. Now, you might look at this and think, hey, a 170% gain for miners? That sounds pretty great. But wait a second. When silver itself is up 140%, that's barely a one-to-one return. Historically, you'd expect these miners to give you 3 times the performance of the metal because of leverage. What we're seeing here is a huge disappointment. And this chart, wow, this really tells the story. It shows the value of junior silver miners compared to the price of silver. And that ratio has just collapsed to a multi-decade low. To put it really simply, miners have basically never been this cheap relative to the metal they're pulling out of the ground. So to really get why this is so bizarre, we have to talk about a concept called operating leverage. Think of it as the magic ingredient that's supposed to make mining stocks absolutely fly when the price of the metal goes through the roof. Let's just walk through a quick example. Imagine a miner's costs to dig up 1 ounce of silver is fixed at, say, $30, okay? So when silver is selling for $35, their profit is just $5. But if the price of silver jumps to $90, their cost is still $30, but now their profit explodes to $60. See what happened there? The price more than doubled, but their profit margin shot up by nearly 5 times. This is the explosive power that the market seems to be completely ignoring right now. So, if the math is this obvious, why the hesitation? Why isn't big money just flooding into these stocks? Well, let's start the investigation and look at the usual suspects. It really boils down to 3 main culprits. First, there's a deep-seated fear, a psychological scar from a past crash. Second, you have some weird market mechanics creating noise. And third, there's the simple, messy reality of what it takes to run a mining business. All right, let's start with suspect number 1, because it's a big one. It's the ghost that still haunts this entire sector, the absolutely brutal silver crash of 2011. This memory, more than anything else, is shaping how investors are behaving today. So after silver spiked to almost $50 an ounce back in 2011, it completely collapsed. And it didn't just fall. It dragged the mining stocks into a devastating 5-year nightmare. Just look at this carnage. We're talking year after year of crushing losses. Anyone who bought at the top got absolutely torched. And that kind of financial trauma, it leaves a very deep scar. And that painful memory leads directly to this. It means that even with today's record high prices, the big institutional money is just sitting on its hands, completely skeptical. They're basically saying, look, show us the profits, show us the healthy balance sheets. Do that for a few quarters in a row, and then maybe we'll trust you. Until then, the miners are on probation. And it's not just the bad memories. You've got other headwinds too. Things like short-term trading that can pin prices down, plus the simple fact that mining is a risky, messy business. Investors are worried that companies will issue more stock or that a government will swoop in with new taxes. It all adds up to a huge wall of worry that's keeping buyers on the sideline. But, and this is a huge but, what if the market is fighting the last war? What if everyone is so focused on the rearview mirror that they're missing what's right in front of them? Let's explore why this rally is built on a completely different foundation than the one in 2011. This, right here, is probably the single biggest difference. Back in 2011, the rally was driven by what you'd call hot money, speculators who could jump in and out of the market in a flash. Today, It's a totally different story. It's a relentless physical pull from industries that actually need the metal. And that gets to the context. That 2011 rally was, well, it was fragile. It was basically choked off when the exchanges changed a few trading rules. This time, however, the rally is being supported by a real-world problem. There literally isn't enough silver to go around. That's a structural deficit, and you can't fix that by flipping a switch. And this is where it gets really serious. Today's demand for silver isn't just some market fad. It's a core part of a global geopolitical strategy. We're talking about governments viewing silver as a critical material for their energy supply chains. This is a whole different ballgame. And we're not just guessing here. The Silver Institute tracked a massive supply deficit of almost 150 million ounces in 2024. And 2025? It's on track to be the 5th straight year where demand is higher than supply. That's not a blip. That's a powerful, undeniable trend. This market is under serious physical strain. So where's all this demand coming from? Well, it's what you might call sticky demand. It's not going away. It's anchored in the global green energy transition, things like solar panels and all kinds of electronics. And it's being supercharged by government policy, everything from putting silver on critical minerals list to tax credits and international partnerships. Okay, so let's put all this evidence together. What's the verdict here? Where does this whole paradox leave us? You know, it really comes down to this. The market is stuck in a battle between memory and reality. The hesitation makes sense. The scars from 2011 are very real. But the facts on the ground today, the record industrial demand, the persistent deficits, the government policies, are just completely different and way more powerful than anything we saw back then. And that leaves us with this one final thought. Fear is a powerful emotion, for sure. But a physical supply deficit, that's a powerful reality. And at some point, the market might have to stop looking at the ghost of 2011 and start paying attention to the physics of 2026. Because, after all, you can only hold that beach ball underwater for so long before it comes bursting to the surface.